Hello everyone, welcome to our video session on regional organizations. In this video we are going to focus on regional development banks, which is covered by chapter 7 in your textbook. Let's start with learning outcomes. After reading this chapter, you will be able to understand the main features of regional development banks. You can evaluate the reasons why regional development banks were designed, and also you can describe the similarities and differences between regional development banks and multilateral development banks. Let's start with overview banking system. Regarding the financial system in a country, there are different processes and terms, concepts. One of them is financial intermediation, which means the process of taking in funds from depositors and then lending them out to borrowers. Financial institutions are performing these financial intermediation functions. They have two main functions. One is to manage the fund generation and payment mechanisms, and the second one is to bring investors and savers closer with fund owners and borrowers. And there are different processes in terms of implementation, monitoring of banking system. One of them is financial evaluation, which is based on structural changes in financial system. And there is another process which is called quantitative measurement of financial intermediation, which is required to conduct a quantitative analysis of monetization as well as to assess its relationship between financial and monetary policies in order to establish a suitable mode. Financial liberalization is also a process of reducing and eliminating price and quantity controls over markets and making economies open to international capital flows. International commissions such as Commission on Banking System and also Basel Committee, these are established in 1974 in order to develop into a global meeting, in order to create a global meeting place for regulators and for developing international standards for the banking system in the world. What is a regional development bank? Regional development banks are multilateral financial institutions that provide financial and technical assistance for development in low and middle income countries within their region. There are different regional development banks: African Development Bank, Asian Development Bank, European Bank for Reconstruction and Development, and finally Inter-American Development Banks. What is the role of regional development banks? They redesign international financial architecture due to the prolonged instability of developing countries and volatility of their access to the global financial markets. These development banks are owned by member governments of both regional and regional countries. They are generally supervised by a board of governance, a board of executive directors, and governed by a president. They are located in their respective region. They have hard and soft landing windows in order to fund generation. What are the main objectives of regional development banks? They help member countries to develop their domestic financial markets so that these countries can mobilize their own savings for investment. They can bring member countries to global financial markets in a sustainable manner, and also they conduct a pro-cyclical behavior of private sources financing. There are two main issues for public sector's integration into global markets, to which regional development banks contribute. One is the access, helping access to financial markets and the survive, and the second one is the prevention and management of financial crisis. There are different tools required for regional development banks in order to fulfill these functions. They need to develop new financial instruments. They need to plan and fashion particular lending policies, and they need to bring their capacity to produce and disseminate knowledge and best practices in a more desirable condition. In terms of financial crisis, regional development banks helping to resolve liquidity problems in financial crisis in their region. And they also engage crisis prevention by engaging in contingent credit operations, and also by providing credits to small and micro enterprises. As for the competitive advantages of regional development banks, what are the problems making integrating developing countries into the international financial architecture difficult? First issue is developing countries have to perform a number of tasks in order to stabilize their economies, such as exerting discipline on their fiscal and monetary policies or enhancing their financial. And second issue is executing second generation reforms to provide an institutional setting suitable for a modern economy, such as protecting rule of law, assisting and creating poverty rights, providing transparency in economic and political activities, improving financial regulation, monitoring supervision, reinforcing banks, and similar structural reforms. The third one is the fact that those countries already achieved or advanced their tasks, still need to defeat the resistance of markets in financing developing countries on a continual basis. And also, risks of financial crisis will not be completely eliminated, so countries must create mechanisms to deal with this crisis. Regional development banks helping these countries in creating these mechanisms as well. The tasks carried out by IMF, International Monetary Fund, can be complemented by regional development banks, because regional development banks deal with a whole spectrum of factors impacting the financial markets, because they deal with long-term end of financing, and they deal with structural and institutional problems development, which requires immediate solutions. The transition from regional development banks to multilateral development banks. Multilateral development banks is a success story of the post-World War II world. They were established to address a market failure in long-term cash flow to Europe, devastated by the war and developing countries. And they're trying to integrating financial capacity and technical knowledge for decades to support the investments of borrowing members during the post-conflict restructuring, growth incentive, and poverty reductions. Multilateral development banks do not only exist, but they also flourish thanks to growing demand for their services and financing. But their role started to expand beyond rebuilding support. They served as a catalyst in encouraging a reform agenda. After the collapse of the Soviet Union, they are motivated to help bring the transition in Central and Eastern European market, which led to the creation of European Bank for Reconstruction and Development. And also their roles expanded, such as promoting ideas, policies, and large-scale programs, and also regularly complementing and building on IMF-supported macroeconomic reforms. And finally, a new financial architecture emerged because of some major changes in international financial system. First of all, the breakdown of the multilateral development banks' traditional boundary between borrowing and non-borrowing countries does not exist anymore, because of fast economic growth of China and other emerging markets in the last 30 years changed this existing financial architecture. For example, China created Asian Infrastructure Investment Bank. Brazil, Russia, India, and South Africa also created new development bank. So this changed the whole spectrum of international financial system. And also, most of the developing countries have their own domestic and international access to consultancy services, policy ideas, and useful example of good practices that seems to be monopolized by the multilateral development banks during the late 20th century. And the legacy multilateral development banks adapted too slowly and very little to growing economic growth, sophistication, and capability of their borrowers, as well as current development challenges. Thank you very much for your participation. This is the end of the chapter 7, and this is a very brief introduction. Please go and read your textbook because it is your main learning material. Thank you very much.